You're listening to Macro Sunday, hosted Crow Sunday podcast. I'm Andreas Steno, your host and the founder of Steno Research. And as per usual, I have my true lieutenant, Emil Møller, with me.
Back at it,
Yeah, head of research here at Steno Research. Just a friendly reminder, it helps us a lot if you like, share, and subscribe to this channel. So thank you very much for your support out there so far. It's been a true pleasure to broadcast this show 25 times, I think now.
Oh, that many?
Yes.
Yeah, time flies, doesn't it?
It does. Yeah. It does. Today, Emil, we're going to talk about duration assets. We've been talking about duration assets in fixed income a lot. Yeah. But we're joined by Cathie Woods.
Yeah.
In 10-15 minutes from now.
Big one.
Yeah, indeed. Yeah. Probably the most famous long duration asset manager within the equity space.
Yeah.
And she's had some tailwind this year.
Oh, definitely.
In sharp contrast to consensus expectations forming before the year commenced.
Yeah.
So we are going to discuss this duration bet, both in equity space and in fixed income space, over the course of the next 45 to 60 minutes. And as per usual, Emil, we need to remind our audience that we have the best disclaimer in the world. So here is Gerardo Gattuso with a warning of the show content.
Sometimes may be good, sometimes may be shit.
Referring to the ideas floated in this show. Emil, we are recording hot on the heels of what I've labeled the lowflation week in Europe.
Yeah.
We were banging the drums ahead of this euro inflation print this week, telling right about everyone and their mothers that inflation would print very soft in Europe.
Yeah, nailed it.
Yeah. So what happened?
Well, I think we're basically just approaching end cycle dynamics where the low side is just clearly outweighing the risk of reemergence of inflationary pressures. And I think you could see that in the data that, the skews are pretty much tilted one way. And, it's basically a horse we've been flogging since summer, isn't it? It's only just accelerated these
especially
past
for
months.
Europe.
Yeah, for Europe in particular. US is a bit of a different story. Perhaps we can get back to that. Yeah. But I think, my thoughts are sort of centered about right now is, so on the way up in this inflationary process, a lot of it in Europe was driven by supply side, even though I've received quite a few slaps for taking that position, but I think the evidence is just overwhelming. And thus the transition of monetary policy just has a completely different weight on the economy at all. So I'm actually not surprised that we're starting to see severe fractures within or on the surface of the European economy as we go along. And I think that's the next step, and we'll probably see it before we do in the US. Yeah. To be fair.
And I think it will be very interesting to see the reaction from the European Central Bank.
Yeah.
They basically sounded extremely hawkish just ahead of this release.
Oh, it's ridiculous.
And it sounded kind of out of whack with the inflation picture, if you ask me. But interestingly, the market is now kind of ahead of this ECB story. We've added another hike to the forward pricing for 24. A cumulative, we're talking about 117 basis points or thereabout for the whole year in terms of cuts priced in. Yeah. The first cut is priced for April. I think we started talking about this Q1 cut in June. Yeah. No one cared to listen. And now it's getting there. Yeah. So, Emil, how do you view the risks for the economy here, given that the European Central Bank, at least by the time of recording, is really, truly yet to admit to this disinflation?
Yeah, it's a good question. The thing is, I think the story of 2023 has been that of a market basically dictating whipped central bankers who have gotten humiliated for quarters on end, right? And I think right now there's so much on the back foot that they dare not do much, and I think they are, at least up until now, more scared of starting to ease in a bit through rhetoric than they are by just by stating the obvious, if you like. So what you probably should be looking at is market pricing and positioning rather than all these rhetorical blunders. I think it was Nagel who said something to the extent of
the
that
Bundesbank.
yeah. Oh, Jesus Christ. Yeah. I think
the next move is a hike. I think he said something down those lines.
Yeah. Something like
could be a hike.
Complete oaf. Yeah. So where I'm sort of leaning at now is I still think market is late to the party, actually. And I think if what we're seeing now in the aftermath of the entire COVID bullwhip will essentially transition to service weaknesses.
Yeah.
And I think that's basically the main case here. And then we are, on the edge of a recessionary, on a recession here. And we see that in the French print today, coming in negative. Already been the case here where we live in Denmark and Germany and so forth. And if that really plays out, I don't think you could. I mean, one cut in April won't suffice. Let me put it that way. It will probably be early and will probably be more potent. Yeah.
So we're still long euro duration
and
20-year plus,
comfortably in the money.
Yeah, 10% up or so.
Yeah.
We caught the bottom pretty well.
Yeah.
It basically means that we are also long the 100 Jahre Austrian fixed income bond as well. That's been a widow maker over the past couple of years, to say it the least.
Yeah.
But
not for the Austrians.
No. They've been carefully on the right side of that, to say it the least. Emil, I know that Cathie Woods has been very vocal in terms of the Fed outlook and the over-tightening of the Fed funds rate into next year. So in relation to this discussion, we're kind of saying the same thing about the ECB right now. We're echoing Cathie's rhetoric around the Fed. I'm not completely in her camp when it comes to the Fed. We can get to that in a second.
Sure.
But we need the soundbite of the week with the true president of the United States, Mr. Donald Trump.
We get cancelled now, don't we? All right.
He was vocal in terms of rate hikes when he was in office as well.
Definitely. Yeah.
So here's the soundbite with Mr. Donald Trump.
This despite a near record number of rate increases and quantitative tightening by the Federal Reserve since I won the election. 8 increases in total, which were, in my opinion, far too fast an increase and far too slow a decrease. Because remember, we are actively competing with nations who openly cut interest rates, so that now many are actually getting paid when they pay off their loan, known as negative interest. Who ever heard of such a thing? Give me some of that. Give me some of that money. I want some of that money. Our Federal Reserve doesn't let us do it. I don't say thank you. The smart people are clapping. Only the smart people are clapping.
He was lamenting the lack of negative interest rates at the time. Probably wouldn't have been a good idea to add negative interest rates to the mix through the pandemic, but
probably not. No.
So, Emil, towards the end of the week, we've seen a rebound in the dollar. Basically on the back of this very soft inflation print from Europe. But what about the dollar leg of this equation? I mean, is the dollar inflation outlook similar to the European, or do you see differences between the two?
No, we see more resilience in the US overall. If you look at price plans, if you look at sticky core measures, and even if you look at some of the rent indices, they're not exactly capitulating yet. So no, I think the trajectory, at least short term, for US inflation is still up in the air. But in general, I don't think we are at a point in the cycle where you should be overly worried about it, lasting inflationary pressures. I think that train has left the station, in my opinion. But still, short term, I mean, it could definitely could definitely wrong foot fast money players if they're on the wrong side.
Yeah.
So yeah.
And by the time of the recording here, we're still pretty upbeat on the manufacturing outlook in the US, both from sort of seasonal considerations, but also due to the orders book improving a few months ago relative to the inventory size. The week ahead of us, ISM services could be an outright banger.
Could be.
So, well, we still lean short here, dollar. That's what I'm trying to say here. When it comes to duration assets, Emil, you haven't exactly been a fan of them over the past couple of quarters, to say the least.
No.
Tech has been performing like crazy lately again. So what do you make of these long duration assets amidst the recession? That's let's take that as the base case assumption for Q1.
Yeah. Okay.
Is that a big issue for them?
Yes, it should be. So my line of thinking here is, and that this is a regret of mine. I should have stepped down a bit harder on this, but I sort of saw this bear market rally coming in November a bit. We didn't quite capitalize on it as much as I would.
We only bought bonds, basically.
Yeah. So that being said, but I think right now I'm still anxious about the earnings outlook, and I think the valuations right now are out of sync with what I see in store for the economy, and how that cannot hit risk assets. That's beyond me. And on top of that, take if you look at just the yield comparisons between, say, the S&P 500 and I don't know, take an investment grade bond of whatever. I mean, they're quite narrow. I struggle to see much of an argument to step into risks short term. Does that mean I would go full out short yet? No, not quite. But I think eventually, the reckoning will come, and Cathie Wood will have a party. No doubt about it. She would have a second round of it.
Yeah, when the liquidity is back.
Yeah.
But I'm kind of a fan of this rolling recession theory.
Elaborate.
I mean, we've had a recession in tech already.
Yeah.
In my opinion.
Yeah.
Exactly a year ago.
Yeah.
Layoffs on a net basis. Very weak earning calls at the time. Weak equity performance at the time.
Yeah.
And that recession is behind us.
Yeah.
We've had a recession in manufacturing. That recession is potentially behind us now. We haven't had a recession in the remaining part of the economy.
No.
So the next part of this rolling recession is a recession in the service sector.
Yeah.
That's kind of my line of thought right now. And in such case, I wouldn't rule out that the Magnificent Seven actually thrives through a recession in the rest of the economy. I wouldn't rule it out.
I think what really matters when you look at the big companies here is they can basically wear out the recession and just maintain their capacity and just wear it on the books, so to speak. But what I'm sort of like, but my general perception here is that that if we see this, say a reversal in equity pricing, I think that would subsequently mean layoffs. And that has to do with the nature of the US economy being as financialized as it is. But I'm not. I'm not. I don't think it's going to be a complete bloodbath. But an ordinary recession, and I think it would be driven by low equity prices as well. So
I think with
unpopular opinion.
Yeah. With those words, it's time to introduce our guest of the week.
Bussin'.
Cathie Woods, founder of ARK Invest, and an avid technology investor.
Definitely.
So to introduce Cathie to the Macro Sunday podcast, we play a piece of Simon and Garfunkel, namely Cathie's song. Invest to the Macro Sunday podcast. Cathie, a tremendous honor to be able to host you here at Macro Sunday. Thank you for joining us.
Oh, my pleasure. Thank you. I've heard all about your show. It's our new partners in London are raving about it.
That's good to hear. Cathie, it's been a very, very strong year for technology stocks. amidst rate hikes from the Federal Reserve, amidst attempts to bring the balance sheet down from the Federal Reserve. What do you make of that cocktail? Rate hikes, balance sheet drawdowns, and tremendous stock performance within the technology sector.
Yeah, it's really interesting. Well, what happened before that was serious damage to certainly disruptive innovation stocks, which, maybe they are in early stages, they're investing aggressively, not making huge profits, but are going to capitalize on tremendous opportunities. In 2021, just the thought of higher interest rates, and then in 2022, the reality of higher interest rates absolutely smashed that part of the market. In fact, all long duration assets were punished. Long term bonds had their worst 2-year period since the 1700s. So really bad time for long duration. And what's happening now is, despite what the Fed says, higher for longer, we could take rates higher. The market is saying, no, there's enough evidence out there that the economy is weakening, and more important, that inflation is coming down and is probably not going to stop at 2%. Why? Partly because of what you said, Andreas, which is the quantitative tightening is still in full force, and M2 growth on a year-over-year basis is negative and has been negative all year. So I have a feeling we're going to continue in the rolling recession that we've been in over the last 2 years. And many people say, what? Well, here in the United States, when I say that, housing sales are down by some measures 40%. Auto sales are in recession territory. Non-residential commercial real estate, especially office, and this is true around the world because of hybrid, is melting down. And so one sector after another, capital spending is now starting to give way. Why? Because companies are losing their pricing power that held up profits. Now they're going to have to cut costs. And I do believe that will mean employment. So it will be obvious the economy is weakening, especially as unemployment rate goes up, and prices coming down. We think below 2% at some point during the next 6 months is going to ring the bell for interest rate cuts. And that's what I think the market is sensing now, and it's beginning to discount it.
What's the end game of the Federal Reserve hiking cycle here? They're yet to truly admit to the scenario that you just described, Cathie. So how do you view the Federal Reserve playbook ahead of us here?
Well, what's been interesting, so there are 12 Federal Reserve districts in the United States. Each one of them has an economics department, which puts out a survey on how their regions are doing. I won't say every one of them, but the vast majority of those districts have been flashing red for at least 6 months, 6 to 9 months. So I think the district presidents understand that not all is well, but Chairman Powell was forcing this unanimous vote. And we're beginning to see a little bit of a divergence now, where you have some saying, oh, we're seeing the economy weaker, or, oh, we think we've done enough to get down to 2% interest rates. So I'd be very surprised if they do hike again. And as I said, I think with falling prices, they will ease.
If we look at the technology sector in relation to this discussion of the Federal Reserve balance sheet and their hiking cycle, how important is the Fed outlook for the overall sentiment in this space?
Well, I think just like the tech sector was a leading indicator on the way down. And what I mean by that is our stocks, which are not in the broad-based benchmarks for the most part, except Tesla. This is our flagship strategy. Our portfolio was down nearly 20% in 21 as the market was rising to new highs. And then it got crushed in 22 as interest rates actually went up. So our ilk of stock, and we're having a very strong year, beating the broad-based benchmarks, in some cases significantly. We saw trouble looming well before the broader market in early 21, and the downturn for us lasted just about 2 years. Now our strategy and our stocks seem to be sensing the opposite. So we paid our dues, and we were the first to go down. I think we're the first out. And what could hurt this point of view is if I suppose the economy turns around on a dime, but we don't think it will. We think it's one by one the sectors are capitulating, and once the unemployment rate goes up, and it has started to go up, I think the Fed's going to be hands off. And I think that's good for tech. Very good.
We've obviously had a tremendous focus on the wave of artificial intelligence over the course of the year. It has sort of stolen the limelight from the crypto space a little bit here. So how do you view those two trends, and how do you see them comparing from an investment perspective?
We think they're both very big ideas. In fact, we publish a piece every year called ARK's Big Ideas. This year it was 2023, of course. And you will see in there, we size the opportunities. And it depends on how you define opportunities. We think in the crypto space, for example, there are 3 revolutions taking place: a money revolution, a financial services revolution, and a digital asset property rights revolution. And they're all big. The biggest one, though, is the money revolution. That's Bitcoin, because it's the first global, digital, decentralized, private, no government oversight, rules-based, critical monetary system in history. We think that's a $20 trillion idea by 2030. And right now, I believe Bitcoin is valued in the marketplace at roughly 700 billion, something around there. So that's a very big idea. And many people in the developed world don't understand how big it is because they are not growing up or living in an emerging market, which is going through hyperinflation and which is destroying purchasing power and wealth. So it's really taking root there. And we do believe when the SEC approves a spot Bitcoin ETF in the US, and we think it's close, and we hope to be among those approved, that will be key. That will be a seal of approval for institutions to diversify into a new asset class. So very big idea. Now, artificial intelligence has taken a lot of the oxygen out of the room in terms of discussions out there, with the exception of the regional banking crisis. And something very unusual happened during the regional banking crisis to Bitcoin and to other crypto assets. Typically, Bitcoin and crypto generally are risk-on assets. You know, they tend to do very well in an overall bullish environment. What happened during the regional bank crisis, we had the regional bank index here in the United States imploding. We had banks going bankrupt, and Bitcoin went up from 19,000 up nearly 50% to 30,000. And we thought, wow, this is proof positive that Bitcoin is also a risk-off asset. What does that mean? It means there's no counterparty risk, unlike in the banking system. We've got a very decentralized, transparent network. You can see all the activity taking place by IP address, no counterparty risk. So a very big idea. In terms of AI is the biggest catalyst to all of the innovation taking place out there right now. So we have centered our research and investing around 5 major innovation platforms. They are robotics, energy storage, artificial intelligence, blockchain technology, and multi-omics sequencing in the life science space. If we have a scoring system that measures which technologies are the biggest catalysts to the accelerated rate of growth of other innovations. In other words, there are convergences taking place between and among technologies. AI is the biggest catalyst. It scores, top of the heap. And we think that every company will have to harness it or lose out competitively, either cost structure wise or new products and services wise. The other side of this is trying to figure out who are going to be the biggest beneficiaries of this absolute boom in innovation. And we think the biggest opportunity out there in the next 5 to 10 years is autonomous taxi platforms. Many people call them robo-taxis. And we think that could scale from essentially nothing today to an $8 to $10 trillion revenue globally, including China, in the next 5 to 10 years. And I know a lot of people say, no way. You see Cruise Automation or Cruise here in the United States, owned by GM, had to basically shut down its autonomous, and GM's pulling away. This often happens with new innovations. And you see players who should stay in the market pulling out, just saying this is never going to happen. And then all of a sudden, it happens and they're not there. We think Tesla is the biggest, performing the biggest AI project in the world. And we think it's in the pole position here in the United States to get what will be a winner take most opportunity in the robo-taxi space. And the interesting thing about that is that will redefine how people think about Tesla. Right now, they think about it as an electric vehicle manufacturer. That's a low margin business. It's in the gross margin category. It's some players are as low as 10 or single digits in China. And we think Tesla will get on the EV side to a 30% gross margin. If autonomous is the next big play here, then that's a SaaS model, software as a service model. And the gross margins there are in the 80% plus. It will redefine what Tesla is doing completely. And so Tesla is doing what Apple did in redefining the wireless space. It developed its own chip, the only cell phone manufacturer to design its own chip. And today it's number one in the smartphone market, computer in your pocket. The others did not define the market that way. Tesla's doing the same thing, only company to design its own chip. And it is redefining the mobility market into autonomous mobility.
In relation to some of these early trend investments, I'd like to get your take on how to actually gauge the value of some of the mentioned stocks, Cathie. If we look at, for example, simple multiples such as 12-month forward price earnings, some of these stocks look outrageously expensive. So what are your preferred multiples to look at when you gauge the value of such investment themes?
Okay, so there are 2 variables here. One is the valuation metric itself, and the other is the time horizon. So our preferred valuation metric is EBITDA, or enterprise value. So that includes both equities and bonds, the whole capital structure, relative to EBITDA. So that takes away the games you can play with EPS as the denominator. So that's our preferred. And right now in the market, that number, depending on how you measure it. Some people would say it's around 14 times, but if you do a weighted average of the S&P 500, for example, it's closer to 20 times. Ours is off the charts, as you say. And why is that? It is because our companies are investing aggressively now. They're sacrificing short-term profitability in order to capitalize on these massive growth opportunities. So I think by that metric, we're over 100 times. So that sounds kind of crazy. What we do in terms of our valuation assumption is we assume that number goes down to a market multiple. We face a tremendous headwind ahead in terms of valuation compression. And our companies have to overcome that with superior revenue growth and margin expansion. So the names of the stocks and companies in our portfolio are there because we see these massive, super exponential growth trajectories. Now, why do I say super exponential growth? In our experience, many people have trouble understanding exponential growth. Exponential growth in our world is, growing at a very nice clip, 15, 20, 25, 30% per year, continuously on average, that kind of growth rate. That's not normal for a lot of companies. They usually grow quickly and then decay to nominal GDP growth. That's how most people think about growth. Exponential is sustained, strong growth, and super exponential is accelerating from that strong growth rate because of the convergence between and among technologies. So we see our strategies, the technologies themselves, forget about our strategies, but the technologies themselves, the growth rates, when you look at all of them together and the convergences, we think over the next 5 to 10 years, those are 40% compound annual rates of change continuously as these technologies converge. We hope to harness our strategies to those kinds of growth rates and maybe even surpass them at some point. So we're willing to take high multiples now because our companies are investing aggressively in the right places to the right degree as a percent of revenue. And it's very tough for short-term oriented shareholders to buy our kinds of stocks. That's why they are so controversial, because you do have to have a longer term time horizon, and you do have to be doing the kind of research we're doing, which is all about disruptive innovation and how rapidly disruptive innovation can occur and can scale.
Cathie, since we're broadcasting this show from Copenhagen, Denmark, we're obviously also interested in your take on the tech space in Europe. A lot of people, for good reasons, immediately think about Silicon Valley and California and the US when they hear words such as artificial intelligence, obviously.
Yes.
But how do you view the investment possibilities within this space in European equities?
Well, we think they're going to increase pretty rapidly around the world, not just Europe, but around the world, because the cost of technology is collapsing. If you look at artificial intelligence AI training costs, they're dropping 70% per year. And just to put some color into that, if ChatGPT if that model had been developed in 2015, 5 years before it actually was, it would have cost about $500 million to develop it. In 2020, when it was developed, it cost only $4.5 million. Today, it would cost $200,000 or less, and the costs continue to fall. So the other thing that's happening with AI in particular is we're talking about large language models and natural language processing. All of us can do that. All of us speak natural languages. So we all could become prompt engineers. if we just prep a bit and use platforms like Replit to help us program. Replit does 80% of the work with artificial intelligence itself. So I think access is going to increase. And this network of VCs funding, the companies in the valley, that is going to be an old model. There are innovation centers springing up around the world. We moved to St. Petersburg, Florida, in 2 years ago because we saw that it was a fertile place for innovation, and we wanted to make a difference and attract tech companies there. And that is happening. It's happening all over the US. It's happening around the world. When I visit the world, there's such an appetite to learn about innovation, and policymakers understand if they don't do something about this, they're going to be losing out competitively and leaving, high value add positions to other countries. So we're seeing, interestingly, regulatory arbitrage taking place. To give an example, blockchain technology. The US, from a regulatory point of view, has been terrible. The EU has been much better in terms of clear regulations, as opposed to the US, all muddled and confused. So a lot of talent has moved into Europe, and actually some of the products they're building, they won't even let US users use because we live in this regulatory regime. So I think there's going to be regulatory competition, and kudos to Europe for being much clearer in that way. Europe is, though, very complicated. This is why we entered the market with a partner. The different languages, the nuances and regulations in the different countries. There may be, EU regulation, but then there's country by country. And then, of course, very importantly, relationships. So there's a lot to overcome. But again, the barriers to entry are dropping when it comes to technology specifically, and regulations are where a lot of the competition is taking place. Now, on that score, I think anyone focused on AI is a little scared of Europe, just because, well, we learned from GDPR, that it's complicated in Europe.
Yeah.
Nonetheless, what has actually happened is we actually abide by GDPR at ARK because we want to service the European community. So, it will happen over time and it'll work itself out. And I think we're going to be using AI. We've just hired a chief investment strategist who's an AI expert to create a heat map of companies, innovative companies around the world, so that we can go and find them. Because again, as the barriers to entry come down, we want to meet these new companies wherever they are.
The final question, Cathie, relates to inflation in relation
Yeah.
to this discussion on technology.
Mhm.
I think it is a question that divides the macro landscape right now. We've had plenty of guests suggesting that we have entered a new secular regime of higher inflation than what we've been used to over the past decade. But where do you find inflation prospects in 5 to 10 years, given your very positive outlook on technology?
Well, technology is inherently deflationary. And in fact, we've centered our research around that concept. The learning curves in technologies, each different technology, means lower costs, which are passed down into lower prices. So we think we actually think we're going into a deflationary period for two reasons. One is good. I just described it, innovation. We'll see unit growth booming in these new technologies, and costs and prices falling. The bad deflation will happen because, well, first of all, we think monetary policy has been too tight. And we're already seeing commodity prices capitulating. Commodity prices today, as measured by the Bloomberg Commodity Price Index, it's called BCOM, are today where they were in the early 80s. We do not have an inflation problem. And in fact, I think some people are going to be looking back at this period and they'll begin to talk about Kondratiev. I don't know if that word means anything to you, but the Kondratiev waves, which are very long cycle deflationary waves. And I just told you there's been no inflation in commodity prices since the early 80s. If you look at it from that angle, and you look at where monetary policy is now, where do we go? Well, we would be going down, and we have been going down. So that's going to be very disruptive as well, as is innovation when it comes to the old world. It's going to disrupt, disintermediate, and perhaps destroy lots of parts in the old world. We see what's happening with traditional internal combustion engine powered cars, right? They can't afford to cut prices, but EVs can because it's a much newer technology. And so they're going to be in a world of hurt, we think, during the next 5 to 10 years as EVs take massive share and continue to cut prices.
Cathie Woods, the CEO and CIO of ARK Invest, thank you very much for being with us here at Macro Sunday.
Thank you. Thank you, Macro Sunday.
Back in the studio from a tremendous interview with Cathie Woods.
Fascinating stuff.
I mean, Emil, I have to admit that I felt a bit like a boomer during that. I'm challenged a bit when we talk about such details within the technology sphere.
Yeah, I'm on the back foot too, to be fair.
Even though I'm pretty heavily invested in it myself anyway.
Yeah, me too. I mean, if you have a beta portfolio, why wouldn't you have a sizable amount of tech stocks? I mean, it goes without saying.
It does. It does.
Yeah. She's probably better at picking them than we are.
I think so.
Yeah.
But Emil, we're not trying to run a beta allocation here at Steno Research. We are an alpha book.
Yes.
Disguised as a sell-side house.
Yes.
I think that's the best way to explain what we actually do. We try to create alpha via all sorts of ideas cross assets.
Yeah.
And we've been long oil into the OPEC meeting last Thursday.
Yeah.
Pretty decently timed, to say the least.
Could scarcely have been any better.
Yeah, we basically timed that little pukey sell-off a Thursday a couple of weeks ago. And
we got
now
murdered online for entering that trade. And now, who's laughing now, guys? Who's laughing now? Okay.
You're not, apparently. No, you are.
Yeah.
But so, given the supply cuts from OPEC here, I mean, time to take a victory lap and take profits.
It's tempting.
It is tempting, right?
Yeah. We are in we are in the end of a cycle. I'm not bullish oil on a long term, say, multiple month basis. Timing the exit is a bit of a thing here, but I think the dynamics that is essentially moving oil prices here are new and of structural nature. I think that as the global economy cools and the Saudis are basically unhappy with the market prices, they've tried to force the hand of the rest of the OPEC, who are basically running low on inflows. And well, meanwhile, we have all the paper hunters such as you and I, who apparently favor the short side in the oil space
on a net basis. Yes.
Yeah, and they're feeling the heat right now. So I think that tug of war there, especially within the OPEC cartel, that's here to stay, and it will probably get. I mean, I could even ask you, Andreas, do you think that the rest of the gang will comply with the new cuts announced?
Not all the time.
No.
No. But what I can say here, if you're one of those being net short in paper space, don't accept a meeting invitation on an embassy in Turkey. They're angry in Saudi Arabia. They're angry.
And state of this.
And the OPEC meeting was a testimony to that.
Yeah.
So, no, I agree with you. I mean, it's a very, very tactical trade, this one.
Yeah. 100%.
And it is running on fumes probably here. I have to admit that as well. Short euro-dollar, long euro duration. Probably rhyme better with our outlooks.
Yeah.
But Emil,
yeah,
we are also long the Thai baht.
That's an exotic one.
It is. And to set the scene for a discussion on Thailand, I found a truly hilarious soundbite and video clip from Who Wants to Be a Millionaire in our pseudo-Russian friends within the Nordic space in Finland. So here's a participant in Who Wants to Be a Millionaire in Finland asked about the name of the capital of Thailand.
Okay.
A. Bangkok. B. Bangdik. C. Bangpussy. Vai D. Bangtits.
No joo, mä oon Bangkokissa käynyt muutaman kerran, että se on nyt aika selkeästi toi Bangkok A.
Sitä ei tarvinnut sen enempää miettiä.
Ei.
Ja se on ihan oikein, ettei sitä tarvinnut.
That's kind of the sense of humor in Finland.
So you're saying I could actually make the first round in Finnish Who Wants to Be a Millionaire?
I think so.
Sign me up.
You should give it a go one of the coming weeks.
Well, I'm recording for the sauna anyway, you know.
Yeah. It looks like we're sending to you live from Finland for those of you watching on YouTube. Emil, the week ahead. As the final discussion point for this week, ISM services, our model is through the roof.
Yeah, it's a contentious one, eh?
Yeah, due to seasonal considerations. Remember the abysmal ISM services print in December of 22. It was also partially weak in November.
Yeah.
The spreadsheets will underpin the value of ISM services this year relative to last year. So it's a pretty big conviction of ours that ISM services could potentially print at levels that would certainly put the limelight back at this December meeting at the Fed.
Definitely, and if you look at pricing right now, it's basically no chance of anything happening, not even a moderate one.
No.
So if you levered on the wrong side and our call here works out, you're in trouble.
Yeah. And for non-farm payrolls, also here, as far as we can assess through the X13 ARIMA seats model, a positive addition from a seasonality relative to usual November, December data. So I still hold on to that view that US data will look artificially strong.
Yeah.
Don't get fooled by it, but the market will be fooled by it. I think.
Yeah, could be.
Dollar could post a rebound. Probably makes sense to pay SOFR contracts in either March or June against European peers, for example.
Yeah.
And such stuff on the back of this. Early next year, the seasonality in spreadsheets will be back with a vengeance in the other direction. But enough of that for now.
It's going to be a one-night stand, this.
Yeah. As you can put it, a one-night stand with ISM services here.
Sounds like a lousy round, doesn't it?
Yeah, it does. Emil, let's leave it at that. If you're listening out there or watching, thinking about Steno research after 60 minutes of rambling here, please go check out our webpage, stenoresearch.com. We'll put it in the commentary section. And remember that we just launched our brand new offering within digital assets, crypto, also a bit of AI. And we offer you 20% on the first 3 payments of your subscription until the end of this month. So go check that offering out. And it is a limited offering. So we don't have full capacity at 20% off. So now's the time to check it out.
Yeah, you're in a hurry.
Yes, indeed. Emil, great to see you again.
Cheers.
And to those of you watching or listening out there, thank you very much for being with us again this Sunday. We'll be back again next week talking about gold, as far as I remember. Something very different from Cathie Woods.
Oh,
yeah.
Interesting.